everyone. This is John Cleaver with Beyond Wealth Advisors, and welcome to our March Economic Update. With me today is J.C. Ganote.
Thank you, John.
Welcome. Over the past few weeks, investors have been watching the headlines about the conflict involving Iran, rising oil prices, and a bit more market volatility than we've seen recently. Whenever geopolitical events hit the news cycle, it naturally raises questions. What does this mean for the economy? What does it mean for the markets? And maybe most importantly, what should investors actually do about it? So today, JC and I are going to walk through what's happening and what investors should really be paying attention to. So let's start with the question that maybe everybody is asking, and that is, how long could this conflict last? So when people hear about a conflict in the Middle East, the immediate fear is a long, drawn-out war. So JC, what's the base case outlook right now?
Right now, the expectation is that this conflict will likely be limited and relatively short in nature for the most part. Most strategists estimate 3 to 4 weeks rather than months or years like some people might think that it could turn into. The U.S. appears focused on targeted operations rather than a ground invasion, and neither side has strong incentives for a prolonged conflict. Just doesn't benefit either side. So while the headlines are serious, the current outlook suggests a contained conflict rather than a major war.
The second question, JC, is why did oil spike so quickly? It jumped over $100 a barrel. What caused that move?
It comes down to the Strait of Hormuz, one of the world's most important energy shipping routes. About 20% of the global oil supply moves through that region, and shipping has slowed due to the conflict. That disruption pushed oil prices sharply higher the other day, but the futures market is already signaling that this spike is likely temporary rather than permanent.
Okay, so that brings me to my next question. Could we see fuel shortages? Because typically whenever oil spikes, people worry about shortages. Is that a real concern?
John, at this point, no. The U.S. and its allies maintain about 1.2 billion barrels of emergency oil reserves, equal to roughly 200 days of Persian Gulf imports. Those reserves exist specifically to stabilize markets during geopolitical disruptions. So higher prices are possible in the short term, but a true supply crisis is really unlikely.
So that brings us to another question, JC. What about commodities? Oil gets really all of the headlines, but are other commodities affected when something like this happens?
Yes, two main ones actually, John. The first is liquefied natural gas, where the Persian Gulf accounts for about 20% of the global supply. And the second one that's interesting is fertilizer, particularly exports from the region. Shipping disruptions could raise costs for farmers, which may eventually push food prices a bit higher. But again, these factors are typically temporary and the conflict is short usually.
Yeah. So how does this all change our U.S. economic outlook? Higher oil prices usually bring some inflation concerns. Does this change the economic outlook?
Not significantly. If the conflict remains brief, as a rule of thumb, every $10 increase in the oil adds about 25 cents to a gallon of gasoline price.
Okay.
So we may see a temporary inflation bump, but if oil prices fall later this year as expected, the impact should fade. Consumer spending and the broader economy remains relatively stable for now.
Okay. So the talk for most of last year was the Federal Reserve and potential interest rate cuts. Could this conflict change the Fed's plans to lower interest rates?
Good question, John. Probably not. The Fed typically looks through short-term geopolitical energy shocks. The expectation remains one rate cut this year, likely, about 25 basis points, driven more by the labor market conditions than geopolitics. So while the market may retract in the short term, the Fed's broad strategy likely stays intact.
So economy and markets are two different things, and the market often tells us something different. Markets have pulled back. Is that unexpected?
Not at all. Historically, the S&P 500 experiences 3 to 4 pullbacks of 5% or more every year, with an average intra-year decline of about 14%. Volatility looks like this simple part of the market's function.
Yeah, for sure. All right. does this change our long-term outlook? We just talked about the short term. The key question that investors are asking is, what about my long-term 1, 2, 5, 10 years down the road?
Well, at this point, no. Historically, markets have actually performed well after geopolitical events, rising about 8% on average in the following 12 months. Corporate earnings remain strong, margins are healthy, and U.S. companies have very little direct revenue exposure to Iran or the broader Middle East. So the long-term fundamentals actually, John, remain intact.
Well, that was fantastic, JC. As we close up here today, I guess maybe kind of the bigger picture. Moments like this remind us that markets are constantly reacting to headlines. Uncertainty and emotion, come into play all the time. But long-term investors succeed not because they predict every headline. They succeed because they remain disciplined through the headlines. History shows us something very clearly. Geopolitical events create volatility, no doubt about that, but they rarely change the long-term trajectory of the markets. So the base case today is that this conflict will likely be short-lived, energy markets will stabilize, and the global economy will continue to move forward. At Beyond Wealth Advisors, our role isn't to react to these headlines. Our role is to stay focused, keep our discipline intact, and focus on those long-term outcomes. Because ultimately, building wealth is not about the next news cycle. It's about having clarity and conviction and really staying the course. So thank you for joining us for this month's economic update. And as always, if you have questions about your portfolio or the markets or the economy, our team is here to help guide you through it. So JC, we covered a lot of ground today.
Yes, John.
How would you summarize it for your clients if you were going to be speaking with them about these topics today?
Really good question, John. I think it's interesting. It seems like the first half of almost any given year over the last 3 or 4 years, there's been something to be focused on that seems to be a little unsettling in the beginning parts of the year, especially when we come off a strong fourth quarter as we have over the last 3 years. Right. Second half of the year, though, is kind of where it begins to catch back up. Right. We realize that these things are short-term lived and that staying the course through these times and not making any rash decisions, as long as the environment for growth in the economy is still there, our portfolios pick back up and we generally have a good second half to the year. So
yeah, that's awesome. So with that, we say thank you for tuning in again this month. As always, reach out to your advisor if you have questions, and we look forward to being back again in April.
Thanks, John.
Thanks, JC.